Chapter 1. Inflation. Section 1. What is inflation? Inflation means the average level of prices is rising over time. When that happens, the same dollar buys a little less than it used to, so your purchasing power gradually falls even if the number of dollars in your wallet stays the same. Not every price increase counts as inflation. If gas jumps for a month, that may just be a change in one market. Economists look for price increases that are broad across many categories and that persist over time. To measure that broader pattern, economists use price indexes such as the Consumer Price Index, or CPI. The basic idea is simple. Track the cost of a representative basket of things households commonly buy, and compare that cost across time. Once you have a price index, inflation is just the percentage change in that index from one period to the next. A base year is usually set to 100, and if the index rises above that level, it tells us the overall price level has gone up. For example, if a typical basket cost $1,000 in 2019 and $1,088 in 2022, the index would rise from 100 to 108. 8. That means cumulative inflation over those years was 8%. So something that cost $100 would cost about $108.80. This is where the difference between nominal and real becomes important. Nominal values are measured in current dollars, while real values adjust for inflation so we can see what those dollars actually buy. Suppose your salary rises from $50,000 to $52,000, while inflation is 4%. Your nominal income is higher, but after adjusting for inflation, your real income is still about $50,000. Buying power has barely changed. That helps explain why moderate inflation is often seen as normal rather than automatically bad. What matters most is that inflation stays low, stable, and predictable, because deflation can weaken spending and investment, while high inflation erodes savings and makes planning much harder. Inflation also does not affect everyone the same way. Borrowers with fixed-rate debt may benefit because they repay in less valuable dollars, while lenders, savers, and people living on fixed incomes can lose purchasing power as prices rise. For investors, the key question is not just how many dollars an investment grows into, but what those dollars can still buy after inflation. If your portfolio gains 5% and inflation is also 5%, your real wealth may be roughly unchanged, which is why real returns matter so much.